Hello everyone, welcome to this weekly price action breakdown on EU. In this video, I'm going to break down last week's price action for you step by step. Most importantly, I'll explain exactly how you could have navigated through that price action, how you could have waited, observed, reacted, and most importantly, executed without losing your mind. I'll walk you through the valid trading opportunities that played out last week and show you exactly how you could have approached them from a structured and, more importantly, a non-emotional standpoint. Now, first things first, let's talk about what matters the most: higher time frame draw on liquidity and the higher time frame directional price. Because you already know the truth, you could do every single thing right on your trade. You could build the perfect market context, you could create the perfect narrative, have textbook-level key levels, clean candle ranges, and even SMT divergence supporting your trade. You could even have precise timing. But if your higher time frame directional bias is off, if your higher time frame draw on liquidity isn't aligned, then none of that would matter. The reality is that trade would end up being a losing trade, and you would lose. You could have everything, as many supporting factors as possible backing up your trade idea. But if higher time frame price action is predetermined to go opposite of what you're expecting, or what you anticipate price to do, then your trade idea would lose. Your trades would end up being losing trades, and none of the market context or narrative you built would matter. That's how important higher time frame directional bias is. That's why I always make sure to first determine the higher time frame bias accurately before I even start waiting or looking for a trade idea on the lower time frame. So first, I'm going to break down this weekly price action for you so you can see exactly how I determined my higher time frame directional bias and draw on liquidity for the week. Based on the liquidity framework, what you can see is that with this move, we had taken out external range liquidity in the form of this high and this high right here. So now the next logical objective or the next logical move for price was to fill internal liquidity before doing anything else. In this case, we had a clean weekly FVG, fair value gap, sitting below current price action. That weekly FVG became my short-term downside liquidity target for price to fill. Since we had taken out external liquidity, I expected, or anticipated, price to push lower and fill this internal liquidity before it could do anything else. Now, looking at the daily time frame, you can see that we pretty much have the same market context. ERL was taken, and now we can expect price to have a retracement profile lower so that we can rebalance and fill internal range liquidity and take out this daily swing low. On top of that, what you can see is that we also got this bearish CSD after we closed below this candle right here. This candle took out external liquidity and then price closed below it, which meant that now we have a change in the state of delivery. This CSD solidified that shift and confirmed that now we can have an expansion lower on the lower time frame so that we can take out this daily swing low and potentially fill the internal range liquidity on the daily time frame. You can see that both the weekly and daily timeframes are showing bearish signs. Based on the analysis that we've performed, the higher time frame draw on liquidity for the week is this daily swing low right here inside the weekly fair value gap. Our directional bias for the week would be bearish, and for that reason, I'd be looking for strictly bearish trade ideas on the lower time frame. Now let's move on to the 4-hour time frame and see how the week unfolded and how you could have navigated through it. Before we do that, you can see that at the start of the week, we also had this newly formed daily fair value gap. On Monday, my expectations were simple. I was, first of all, looking for price to push higher into this daily fair value gap, and then form the high of the week there, and expand lower from that point. That was my working theory on Monday. I was expecting price to first fill this internal liquidity, fill the fair value gap, and then expand lower toward this draw on liquidity. Now let me break down this 4-hour time supply and price section for you here. Let me show you exactly how you could have traded it, navigated it, and what the valid trading opportunities were throughout the week. First of all, on Monday, price was stuck inside this range. Above this range high, we had the daily FVG fair value gap and the daily key level. My plan for Monday was clear. I wanted price to take out this range high, test the daily key level, and form the high of the week there. From that point, I wanted to see lower prices until we took out the higher time frame drawdown liquidity. So on Monday, for the first half of the day, I sat back and waited for price to take out this range high before I could take an entry. During the 9 a.m. 4-hour candle, what you can see is that we expanded higher, took out the range high and tapped into the daily key level. Once that happened, at a key time during the 9 a.m. hour, I then dropped down to the 15-minute time frame. From there, I started looking for a bearish order block confirmation entry. Let me show you. You can see that the range was taken right here, and from there I wanted to see an order block form so I could take an entry. But as you can see, we never formed any order block entry. Instead, price kept expanding higher without offering any entry until the London close kill zone ended right here. After that point, I don't take any trades or entries, so my trading day was done here without taking any trades. On Monday, I stayed risk-off for the whole day and did not take any trades. That's how I ended Monday, with no trade ideas or entries. And that right there is one of the biggest lessons. Sometimes your bias could be right. You might have identified the correct key levels, and your timing might also be spot on. But if your entry isn't there, if the entry setup and the entry model don't align, then you still have to walk away without taking any trades or executing anything. The reality is that you don't get paid for taking more trades. You get paid for trading your system and sticking to that system at all times. Just like that, Monday ended with 0 trades. But that was a win in itself because I stuck to my plan and didn't take any trades, just like my system and my model told me to. That's what happened on Monday. On Tuesday, my directional bias was bearish and I was looking for bearish trade ideas. But obviously, I couldn't just force a trade idea right away. First, I had to wait for proper market context to form, something like a key level and a candle range, before I could frame a trade idea. The major difference on Tuesday was that we now had a CSD, a change in the state of delivery, along with other factors. We had a 4-hour CSD confirmation. This bearish confirmation came after price closed below a particular candle. That confirmed the order flow had turned bearish, and we could now expect a clean expansion lower toward the higher time frame Fibonacci liquidity. This 4-hour change in the state of delivery and the 4-hour CSD added even more conviction to my bias and analysis. Because of those factors, I kept looking for a bearish trade idea throughout Tuesday. In the first half of the day, during the London open kill zone, we didn't have a proper market context, so I couldn't frame a trade idea. But then, during the 5 a.m. 4-hour candle, price pushed into a 4-hour key level, in the form of an order block, and at the same time, we also saw a liquidity purge above the high of a certain candle. Once that happened, a proper market context had formed. The directional bias was aligned, and from there I dropped down to the 15-minute time frame and started looking for a bearish trade idea. Right here on the 15-minute time frame, after price pushed up through this candle's range high and tested the 4-hour key level, I started looking for a bearish order block confirmation and entry. What happened next was that after price closed below this candle, specifically the open of this candle right here, we formed a new order block. I took this candle as my order block, placed my entry there, set my stop loss above the order block, and targeted a 3R trade. But guess what? Instead, price went above and invalidated the order block. I took a loss. The catch is, it was a clean, proper, fully planned and valid loss. And I accepted it. Why? Because it wasn't a bad trade. It was a valid trade, and I take the same setup every single time when it shows up. This right here is exactly the real separation point between someone who has an edge and someone who just wings it. The reality is, I don't rely on being right. I rely on showing up and executing based on my logic and my system. I know that losses are a part of that system, because I understand that losses are inevitable and baked into my edge. When I experience them, when I take those losing trades, I don't get emotional. I don't start jumping around. Instead, I take that loss with maturity, journal it in my notes, and move on. That's how you behave when you take a loss. Instead of panicking or getting emotional, you should channel that loss, accept it, embrace it, and then move on. Looking at this 4-hour time frame, what you can see is that after I took that loss on Tuesday, price pushed lower. Then, on Wednesday, I still had the same bearish directional bias and continued looking for bearish trade ideas. During the London Open kill zone on Wednesday, the first thing that happened was a liquidity purge above the high of the 9 p.m. candle. At the same time, price also tested a key level defined by this 4-hour candle, which I had marked as my order block. Once price purged the liquidity above the high of that candle's range and tested this key level, I began looking for a bearish auto block confirmation entry on the 15-minute time frame. The key point here was that all of this aligned with a key time, which added even more conviction to this trade idea. Right here on the 15-minute time frame, what you can see is that after we purged the candle range right here and tested the 4-hour key level at a key time during the London Open kill zone, from this point on, I waited for price to close lower so that we could form an order block. In this case, we closed below this candle right here, and once we engulfed this candle, it turned into an order block. Then I waited for this order block to be tested. From there, I expected price to push lower toward the higher time frame buy-side liquidity. It was tested right here, and I took my entry here with my stop loss above the order block. I targeted a 3R trade, and once the order block was tested, you can see that it had a clean expansion lower. Then on Thursday, we still hadn't reached the drawn liquidity, the high time frame drawn liquidity. For that reason, my high time frame directional bias remained bearish, and I kept looking for bearish trade ideas even on Thursday. On Thursday, you'd notice that the market context and the approach, or the logic that I was using, was the same. That's because my system and my model are mechanical, and more importantly, logical. It follows the same principles throughout. That's what you'd notice in my system. You'd see that it's repeatable. Every single day is an exact replica of the previous day, and that shows that I have an edge. Most importantly, a consistently repeatable and mechanical edge. On Wednesday, I waited patiently and looked for the same thing, just like I did on Tuesday and Monday. Now, even on Thursday, I'd be doing the same thing all over again. I know it's getting repetitive and it's getting boring, but that's what trading is all about. That goes to show what professional trading truly is. You keep doing the same thing over and over again, you keep doing the boring things, and you don't change anything. That's what brings you profits in the long run. So on Thursday, first of all, I waited for a proper market context to form before I could frame a trade idea. During the London kill zone, we didn't have a proper market context, so I stayed risk-off and didn't take any trades. But then, during the London lunch kill zone, during the 4-hour 5 a.m. candle, what happened was that we tested this 4-hour key level. Along with that, we also purged liquidity above this candle's range high. Now you might be wondering how this candle is an order block. The simple truth is that this particular candle purged the liquidity above the range high and then got engulfed in the form of price closing below it. Because of those factors, this candle turned into an order block. Once price retraced higher to test this key level, this order block, and purged the candle's range high, from there I expected price to expand lower toward the drawn liquidity. That's also where I looked for a 15-minute order block entry in the form of a bearish order block confirmation setup. Right here on the 15-minute time frame, what you can see is that after we tested the 4-hour key level, we then pushed lower. The price closed below this candle right here, which turned this candle into an order block. What I did was put my entry at the low of this order block, with my stop loss above it. I targeted a 3-hour trade, and you can see that this trade also ended up being a winning trade. Just like that, I ended the week with 3 trades, one of them a losing trade and 2 winning trades, each with 3-hour profits. That way, I ended the week with 5 profits.